Did you know that Canadian Tire has a REIT? Fasten your seatbelts, folks. This is going to be a good one. CT REIT is a closed-end real estate investment trust that primarily owns and manages, well, a large portfolio consisting predominantly of Canadian Tire stores. To be clear, Canadian Tire does not own CT REIT directly, but it has a significant relationship with them. They were initially spun off from Canadian Tire back in 2013 to manage their retail properties. Canadian Tire is, well, thus their biggest tenant and, of course, their biggest shareholder. This close relationship ensures that Canadian Tire continues to influence the management and operations of the REIT, given, of course, their shared interest in the success of those properties. When you look at Canadian Tire, they have been struggling in the last year, with their share price dropping by, well, 26%. Holy banana bread. This was due mostly to an overall weakness in the retail sector. Despite that, as we progress through this deep dive, it is important to remember that even during this slide, Canadian Tire is certainly making their rent payments to CT REIT. The struggles that CT REIT has endured has been more related to higher interest rates. Join today's conversation. Let me know in the comments if you hold this REIT or, well, maybe you hold Canadian Tire instead. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more, and another huge thank you for that click. CT REIT last released earnings in February. These were for their Q4 2023 earnings, and they will be the numbers we will be using in this deep dive. Some highlights from that report did include they added more than $150 million in investment that added 840,000 square feet to their overall portfolio. They also had a brand new 350,000 square foot net zero distribution center in Calgary, and that was completed this year, so that's a feather in their cap. In addition to that, they extended 28 Canadian Tire store leases. They also issued $250 million in unsecured debentures to help finance their activities. It gets the job done, but unsecured debt is a wee bit on the risky side. Of course, their Q1 for 2024 is expected to come out in May, so that may be one to look out for. I certainly do like Canadian Tire, and by extension, I am a fan of this REIT, but we do need to ask if the numbers are a fan of this REIT. So to do that, we need to call on the one and only numerator supreme, Mr. Math. We will start with some basic surface data. Their current value at the time of recording is $13.30. They have a market cap of $3.10 billion and a pretty average looking beta of 0.96. Their earnings per share come in at 0.87, and they have a price to earnings ratio of 28.99. Amongst their peers, the average actually works out to 43.1. Some of those pairs being Choice Properties REIT. They have a PE ratio of 5.3. Smart Centers has a PE ratio of 7.7. RioCan way up there with 135.4. So that average may be skewed a little bit to the high side thanks to RioCan. When we look at the price to book ratio, that comes in at 1.80. The average amongst those same peers, 0.90. Their return on equity coming in on the low side, 5.98%. Return on assets, 3.82%. Their surface data is mostly okay. I would, though, of course, like to see higher ROEs and ROA values, but that hopefully will improve when we get into a better rate situation. Okay, let's peel back that top layer and take a good look at their cash flow data. They have a revenue of $552.77 million, and their earnings come in at $105.29 million. Now, we do not have a projected earnings growth for this one. However, we do have their projected revenue growth, which comes in at 3.9% per year. Their profit margin, 19%. They've got a free cash flow of $425.06 million. Same value for their operating cash flow, $425.06 million. Let's take a look at their fair value. We used their current value of $13.27, and then using a discounted cash flow model, we did calculate a fair value of $20.47. That does put them undervalued by 35.7%, so that's not too shabby. Looking out into the future, the one-year projection on this REIT comes in at $15.50, so they're expected to go up by 17.7% this year. That's not too bad. The cash looks okay for the most part. part. Once we do cut those interest rates, that will free up more cash for the company to hopefully improve on those numbers and hit that analyst target. Okay, let's go even deeper and take a gander at the returns. These most likely are not going to be very ideal at all. We'll start with their dividend. They have a yield of 6.82%. That's a monthly dividend of 7.5 cents per share. Payout ratio on that a little high, 101.79%. Rate cuts should help get this back under 100%. Though you do have to keep in mind, though, REITs, well, they pass their profits on to us so we can take the tax hit. So this number will usually be on the higher side. If we look at their 5-year average dividend increase, that comes in at 3.81%. Let's take a look at their return on investment. So for the 3-year, their price fell from $16.59 to $13.30. That is a negative return on investment of negative 19.83%. Even their dividends don't save them. It's still in the negative. Total return of negative 4.23%. Looking at the 1-year, their price fell from $16.20 to $13.30. So that is a return on investment of negative 17.90%. Total return, negative 12.38%. Are we going to see some positives in the year to date? Nope. That return on investment so far this year is negative 8.97%. Even the dividends factored in give us a total return of negative 7.43%. Once again, these are not ideal values in any way, but there is hope as the fall has been slowing down. And with many REITs, we are expecting better times once the rate cuts begin. Okay, let's peel back that last layer and check in on their debt situation. They have a total debt of $2.88 billion, and their equity comes in a little better, $3.85 billion. That's a debt to equity ratio of 74.9%. One good thing is that they have been managing their debt better, as that debt to equity ratio has come down from 83.4% over the last 5 years. They do have a little bit of cash and cash equivalents, adding up to $20.77 million. Well, let's look at that short term. On the short term, their assets come in at $28.86 million, and their liabilities, $332.93 million. I'm not really liking the look of that short term. So let's take a look at that long term and see if it can give me better feelings. We have assets of $6.94 billion and liabilities of $2.79 billion. The long term is much better, and that short term will improve as we move into a bull market. This is another case where I can say the debt could have been worse. You do have to take, though, into consideration that a REIT is going to carry a sizable amount of debt. That's how they buy new properties. What I don't like about their debt is that it is not well covered by their operating cash flow, but on the other hand, the servicing of that debt is well covered by their EBIT, so the earnings before interest and taxes. I'm pretty sure we do have enough to ask that one question. What is my final verdict? Canadian Tire is a retail staple, and as such, they are not going anywhere, which does bode well for this REIT, as their number one tenant will be a reliable long-term source of steady revenue. Once we move into a rate cut scenario, as well as the developing bull market, things will look much better for REITs in general, and, well, for this one as well. This is a good long-term prospect for most portfolios. Recovery will bring growth, and their dividend is not too shabby, as we are looking at a good total return option for at least a few years into recovery. Maybe more, but we will have to reevaluate before then. For the passive income investor, this is not a bad dividend, and even if you only want to ride the recovery train up, you could always do that and take profits and move on to higher dividend options at a later date. Nonetheless, these are not bad dividends, the downside being that they are 100% taxable if you are not holding them in a registered account. Overall, this is a solid REIT with a lower level of risk and the potential for a steady recovery in a lowering rate environment. They utilize debt, so that will always be higher. If you are interested in this REIT we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on Bell Canada. Thank you for watching, and I will see you in the next video.